You don't have to settle for low single-digit returns on capital as the Fed begins to cut interest rates. In this video, we show you how you can capture a return of up to 24% in a single year using covered calls. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005 and proud to have developed number 7 and even 8-figure per year traders. Watch, take notes, and learn from a professional trader on our proprietary trading desk so you can grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And traders and investors all over the world are about to be faced with a pretty stark reality that the high interest rate environment that investors have enjoyed over the last few years, well, that party is just about over. The Fed has clearly signaled that they're going to be cutting rates probably multiple times this year. And so the days of being able to stick any free cash that you happen to have lying around into a money market fund and get over 5% with close to no risk, those are coming to an end. And so traders and investors are going to have to find some way of dealing with the reality that if they want to keep producing cash flow at high rates for themselves in a lower interest rate environment, then they're going to have to figure something out. And so the purpose of this video is to teach you one very simple, time-tested way to produce extra cash in your account, and that is through the strategic use of what options traders refer to as covered calls on high-yield dividend stocks. Before we get into this important topic more deeply, if you're absolutely brand new to options trading and you don't know much about options or how they work, we've created a video for you to understand options basics. So click the video appearing now on your screen if you need that kind of basic information. It's going to lay out the groundwork for you to understand the options strategy that we're going to be sharing with you in this video. So when you're finished, you can just come back and watch the rest of this video. One of the most consistently high-yielding stocks is Altria, the cigarette company, with the trading symbol of MO. And back in 2022, MO was paying a dividend of 94 cents a share every quarter. And as you can see, MO had rallied in the first 5 months or so of that year, reaching as high as 57 at one point, but then began to sell off in early May, and by July had dropped to around 43. And so let's say that on July 22nd, we pulled up an options chain for MO, and we took a look at the November options chain expiring about 4 months later, and we went to a strike price slightly above where the stock is trading, the 45 strike price, and we went ahead and sold 10 call options at a price of $1.49, and at the same time we bought 1,000 shares of MO for $42.98. Well, when a trader does that, buying shares of a stock while simultaneously selling calls of that same stock, the trader is entering to what is called as a covered call position, because if the 10 call options, which of course represent the right to buy 100 shares for each call option at the strike of the call, if those 10 call options get exercised, then he'll have in his account 1,000 shares of MO to fulfill that assignment. And so the 10 calls he sold are considered covered by the 1,000 shares of stock that he owns. So that's where the term covered call comes from. Let's now break down the cash flow of this initial trade so you can follow how this campaign for cash income works. And so first off, we pay $42.98 per share for 1,000 shares, which obviously costs $42,980. But then we immediately receive some cash by selling the 1045 calls for $1.49. Remember, each options contract represents 100 shares of stock, and so we multiply that $1.49 price by 100, and we sold 10 of them. And so when you multiply that all together, you end up receiving $1,490, which netted down from the cost of the shares yields an initial cost of $41,490. Okay, so this strategy involves a lot of situations where we're receiving cash income, and so we're going to start keeping a scorecard so that you can follow how this works. And so the day the trade starts, we'll enter the $1,490 cash we received for the initial 10 calls we sold. Remember, this is a high yield dividend stock, and so those quarterly dividends are going to be starting to come in. And as you can see, the first one we receive is for 94 cents, and that dividend is paid on October 11th, which for 1,000 shares becomes a cash deposit of $940. Okay, so let's now move to the day that the calls expire, which is on November 18th of that year. And as you can see, MO closes at 44.20, meaning that the 10 calls up at 45 expire worthless, because there obviously is no value to a call that expires higher than the shares are trading in the marketplace. And so those calls just die, and we pocket the $14.90 that we receive for selling those. The way that a covered call campaign works is that immediately after one set of calls expires, you go right ahead and sell a new, fresh set of covered calls. And since we're spacing these 4 months out from when we entered the trade initially, and again, sell the 45 calls for, in this case, $1.81. But this time, as you can see, they expire on March 17th. And so adding to our cash flow scorecard is yet another $1,810, as you can see from the calculation. And don't forget, we still have that flow of dividends quarterly. So on January 10th of the new year, we added another $940. Okay, so now let's move forward to the day before the new set of March calls expire. And as you can see, the stock is trading at above the 45 strike price. MO was trading at around 46. And so to avoid those options being assigned the next day at the strike price of 45, which would mean that we no longer own the shares, so the campaign would end, we instead do what options traders refer to as a roll, closing the short March calls about to expire through buying those calls at a price of $1.22 and simultaneously selling the 45 calls expiring in June for $2.33. And so on our scorecard now, we need to account for the fact that we just had a cash outflow event through buying back those March 45 calls in the amount of $1,220, but then turning right around and selling those 45 calls expiring in June for $2.23, which brings in $23.30. And so in this case, while we had to spend some cash to protect the shares and continue the campaign, we still ended up increasing our cash flow because the buyback of the long calls was actually less expensive than the amount of cash we brought in selling the June calls to complete the roll. And remember, we still own those shares, and so MO issues yet another dividend on April 23rd for another $940. If we move to June 16th, we're going to see that MO closed at 44.07. And so in this case, the calls just expired worthless as they had in a previous example. And so at this point, suppose that we closed the campaign and sold the shares for $44.07. Well, that of course would create effectively another cash inflow event, selling the shares in the amount of $44.70, which when you subtract from that the original $42,980 cost of the shares originally, provided us with a small realized capital gain in the amount of $1,090. And you might at this point think that the covered call campaign is over, but actually it's not, because there's one really interesting thing that takes place. You see, the shares we sold on June 16th, well, we obviously owned those shares the day before on June 15th. And interestingly, the way equity dividends work, a dividend is paid to anyone who owns the shares as of what is known as the record date, which was June 15th. And so anyone who owned those shares as of June 15th, even if they sold them immediately after that date, still is entitled to receive the 94-cent dividend. And so as a result, yet another $940 is paid out to us, resulting in a total of $9,260 for the entire campaign. And so comparing the traditional dividend collection approach, inclusive of the capital gain we just mentioned, you'd have earned a return of 11.3%, whereas using the covered call approach, the return skyrockets to 10 points higher, a fantastic 21.5% return. Okay, so what I'd like you to take away from today's video is that you're absolutely not a captive of changes in the yield curve and dropping interest rates. You can earn incredible returns by combining covered calls and dividends on high yield stocks together. And even with very minor capital gains, you could score outstanding one-year returns without very much work at all, just the knowledge you've gleaned from today's video.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction. Then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.